It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. And, today I really want to discuss, some things that we need to look forward to, or look out for, I should say, and how Your Personal Bank certainly could be part of, if not the solution, and a lot of that has to do with inflation, with the economic situation we have going forward, with in terms of growth, stock market, real estate market, things like that, having your money go further, reducing your taxes, having liquidity, more access to your money, and all those kinds of things. We're going to discuss those things today, and I guess one of the things I want to really touch upon is, there's no question about it. It's a fact that we are in the highest inflation scenario we've seen in over 40 years. The consumer price index is at 7% increase year over year, which is, again, the highest rate since 1982. I think the last consumer price index numbers we've seen are something like in the 9% range. I'm sorry, the producer price index. That's nuts, folks. That's crazy, because that's even a scarier number, because that predicts what inflation is going to be like about 6 months from now. Because, again, that's the prices that producers are paying to make stuff. And understand, if it costs them 9% or 10% more to make stuff, the businesses are not going to pay that. It's going to get passed on to the consumer. So the trend is still climbing up, folks. That's the thing I want you to understand. Those that are saying, even the Federal Reserve is not saying it's transitory anymore. And they're saying sometime in 2023, I think, the last I heard them. But who knows? They're guesstimating. They told us it was no big deal at first, and then it was transitory. And they were wrong on both of those counts. So why would the Federal Reserve be right on this scenario? The reality is, right now, we're in the highest inflation in 40 years since the 1970s, and it's still increasing. That's where we're at right now. Now, the argument is there's supply chain issues as one of the causes, and I believe that was the case, certainly previously, more so. That's becoming less so as we go forward. Continue to go forward. Supply chain issues are alleviating themselves because companies are they're creating alternative sources of supply chain, plus things have been done to kind of grease the skids on a lot of those areas. In other words, understand this: businesses don't make money if they can't provide the product to the consumer, can they? And shelves of all kinds of things, there's limits on things, but overall, we're seeing more and more. We're not seeing a lot of empty shelves, at least I'm not hearing about it. We see some of it in certain items, but not like across the board. You know what I'm saying? And it does take longer to get things, so many things, but all at the same time, many things are available, and they're getting the lead times are getting shorter. I think that's pretty clear. So the inflation that we're experiencing now has less to do with supply chain issues than it did, say, 6 months ago. 6 months ago, when there was more COVID shutdowns and more things like that stuff going on, certainly you could attribute a good portion of inflation to supply chain issues, but that's lessening and lessening as time goes. What's causing it now? Well, as I've been discussing with many people, and as you know, I'm in the financial industry. I'm on a bank board, and we got some cool news on that front, but I'll leave that for a later time. The federal government helicoptered over $6 trillion of money into the system over the past year and a half or so. It takes some time. That's an unprecedented amount of money. It's hard to fathom how much money that really is, but it's amazing. It's like over twice what the annual budget spending of it's like 250% increase of what's normal. Okay, more than double. It takes time for all that to kind of percolate through the system, okay? People don't just spend it all at once, or businesses don't just spend it all at once. It takes some time. So we're going to see these effects of inflation. Clearly, the consumer price index and the producer price index are on an upward trend still, and are pointing to, at least for the next 6 months, still on an upward trend before we crest, if you will, and then start to go back down. How long that's going to take, unknown. Hard to say. We're really in uncharted territory. There's no question that the stock market has started to feel the pain, so to speak, in just about every area except oil so far. And no question that we're seeing the high prices of real estate start to abate. Things are, if I had to guess, and I'm not a real estate expert, but I pay attention, it's pretty obvious. My wife's been looking at it very closely and watching the prices, and we're noticing, and she's seeing on a regular basis now, price reductions. And for the last couple 3 years, that was unheard of almost. All right, particularly in places where we live, like in Phoenix. It's a growing area. So we're dealing with inflation. We're dealing with increasing inflation at this point. For how long? Nobody really knows, but it is here, and it is definitely impacting things. So what do? Well, one of the biggest ways, I've talked about this so often, one of the biggest ways to help offset inflation is you need your money to go farther, for one. So how do you get your money to go farther? How do you increase the rate of return on your money? Well, most people, when they're looking to do that, typically take on additional risk. Higher risk typically potentially gives you higher rewards, right? Yet, with the economy the way it is, with the unprecedented level of debt, the higher inflation, some uncertainties about what futures holds, taking on higher risk for most people that I talk to is not something they really want to do. In fact, they're running to do the opposite, and that is reduce risk, if anything, right? Certainly not increase it. So really, one of the best ways to do that is creating cash flow or positive arbitrage. In other words, earning more interest on your money than you would without using it. Now, how does that work? Well, again, your personal bank is one of the best ways you can do to create positive arbitrage. And what we do is quite simply is you set up a high cash value policy to generate dividends. So we want to maximize dividends. We have companies that are paying 5.75%, 6% dividends for the last 25 plus years, have locked in those dividend rates for the next year or two, depending on which company, already, and have never missed a dividend since literally before the Civil War. So again, these are companies that are paying solid, consistent, steady Eddie dividends at the 5.75%, 6% range or higher. Historically, the averages have been more like 7% or better, okay? 7 to 8% actually, on a tax-free basis if it's set up properly, which we do, of course. So now you're looking at a steady Eddie, consistent return in the we're in the low end of the range right now at 5.75%, 6%. And with the interest rates likely increasing, as the Federal Reserve is talking about this year, we are very likely to start seeing higher dividends as we move forward, going forward over the next several years and getting back in the more historical norms, which are around like 7% or better. My point is, the idea is to get a steady, consistent return on your money, tax-free. Then we access the funds through a bank line of credit. And the key is really simple. Your dividend you're earning is less than the interest you're charged. When you access the funds, you keep the difference. Now, what is that? The average person that I'm working with, client, is getting a 2 to 3% positive arbitrage. And here's the key. Here's the takeaway, folks. That is on money you spent or allocated elsewhere. In other words, if you took those dollars and you took them and invested them in an investment, and whatever that rate of return is on that investment, you can now add an extra 2 or 3% to that if you use the positive arbitrage. So you can take money and invest it and make your return, or you can fund it into a policy during the dividends, access to the bank line, pick up the extra 2 or 3%, and now take that money and invest it. So now your rate of return is increased by 2 to 3%. Now, if you were investing in something that had, I don't know, even a 10% rate of return, which most people today would think is pretty good, I think, you now increased your rate of return to 12 or 13%. Is your money going farther? The answer is absolutely. Are you, with inflation, that's key, right? You've got to make your money work for you more. That's the point. And if you're increasing from, say, a 10% rate of return to, say, a 12 to 13% rate, you now have increased your rate of return by 20 to 30%. Folks, that is not a small increase. In fact, that is a massive increase on rates of return. And if you multiply that out over a period of time, let's say a decade or two or longer, the amount of money you'll have over that time will be significantly more than if you don't use positive arbitrage. And that's why so many people, and this, when they talk to me, and I'm going to talk about some scenarios and some situations that I run into today, recently. But now you start to understand a little bit why the wealthy keep getting wealthier. They keep earning more money no matter what. You understand how institutional investors often work, how bank investors often work. Okay, all these types of things. That's how they operate with money. And one of the things I always tell people is, look, you can like banks or hate them. Doesn't really matter. We can all agree they're savvy about money and they know how to make money. Okay, well, why not learn from them? In other words, why just take your money and invest it in an asset and you get the results of whatever the asset does, good, bad, or indifferent? Why settle for that? Institutions don't. Banks don't. Okay? Wealthy individuals and investors don't. In other words, why not get a cash flow on top of it? Why not get the rate of return plus a cash flow, plus a positive interest, plus a positive arbitrage? Why not get both? And you can do that with your personal bank. And that's the key and the difference, the key difference, which was what makes it so unique out there typically to most investments. It's not taking away from your investment, it's adding on to. In other words, you're getting your increased rate of, you're getting your rate of return, whatever that may be, plus a cash flow. What could be better than that? And again, with a higher interest rate environment or inflationary environment, folks, if you just want to mark time, not lose ground, your money has to work for you more. It has to go farther, or you're going backwards. You're losing ground financially. Okay, so again, it's more important than ever to get your money to not only grow for you, but create a positive cash flow or a positive arbitrage. Make your money grow farther, go faster, and build farther. And it's like I said, if you want more information on this, contact me at toll-free 866-268-4422 or yourpersonalbank.com. I'm going to recommend you stay tuned in the next segment because I'm going to talk about something that I briefly discussed in the last show, but I'm going to talk about what are the things we need to kind of keep our eyes on going forward. What's coming up? What's next? So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And, well, we're talking about some things to kind of keep an eye out for, what to look for, and then again, how your personal bank can be part of, if not the solution, to help offset those the higher inflation and things that are happening to us right now as we speak. So, it's no secret we're in the highest inflationary environment we've seen in 40 plus years. And the cost of goods and services has gone up for a number of reasons. But the reality is investments are taking a toll. Wages, income is taking a toll because, the cost of things it's more expensive, right? And we're talking about some of the basics like food and clothing and housing and transportation and energy and all these things that we basically need to live. So it's costing more to live. Our investments have to move forward faster just to keep up with what they were doing last year, for example, because of the higher inflation. Creating a positive cash flow or a positive arbitrage in addition to investing on the same dollars is one of the big keys to keeping up with inflation. So one of the things, like I said, if you missed what I was talking about, go to yourpersonalbank.com. You can listen to any of this or any of the previously recorded shows. And I went into it more in the first segment. So I encourage you to check that out. Now, one of the things that's interesting, a couple of things to look at going forward. Inflation certainly has an impact on the stock market. We're starting to see impacts there. We're starting to see it in the real estate market. Typically, it depresses prices and values because, more dollars chasing these things. So, we got cost of goods and services cost more, but like investments tend to suffer. Okay. Well, one of the other things to be concerned about is a bigger picture thing here is China, which has been the economic engine of the world for some time now, has now just announced for the 5th consecutive year a steep decline in the number of children being born. Okay, we know there was a one child policy in China for quite some time, several decades, and that really, really curtailed their population growth. Well, now, they took that away. In fact, they're now allowing families to have 3 kids. Now, the fact that a government has the right to tell a family how many kids they can have, you want to talk about no rights? I mean, that's a whole different discussion. That's communism for you. But the fact is, they're not only telling families they can have 3 kids, now they're encouraging them. They're trying to get them to have more kids because they're giving them cash grants and extended maternity leave. But unfortunately, it's not working very well. They're not having much success because they've kind of integrated this one-child policy and limited for so long. They're having a lot of hard time. And remember, China is built upon, their economy is built upon labor, the ability having a lot of people that can make stuff. And they are starting to lose that. And as we go forward, to continue to go forward, there's already discussion that, economic growth. Government said China's economy grew 8.1% last year, but tumbled to 4% in the fourth quarter, year-over-year average. And the predictions are more sluggish as they have more sluggish population growth. We're going to, from a demographic standpoint, we're going to see more sluggish economic growth because you don't have more kids. Families spend a lot of money, right? And that's your future. That's your economic growth and all that. As you continue to decline, economic growth stagnates. Look, if China does continue slowing down economically, that will have a major impact on things like stock markets and various things like that going forward, more of a longer-term picture. There's no question over the last decade or so, we saw historic stock market gains and real estate market gains. A lot of that because of easy monetary policy by the Federal Reserve and world banks around the world, inflating the values of assets. We're now seeing inflation. It has 40-year highs and on an increase, still on an increasing track, still increasing. As CPI and PPI are both showing us that it's still increasing. So we haven't peaked yet. We don't know where that is yet. So that's going to have a negative impact on asset values. And, of course, cost of goods costs more to live and purchase goods and services, even the basics. There's a lot of things here that could be challenging headwinds going forward. All right. And so one of the things, like I said in the first segment, you need to make your money go further. That's one of the big keys to weathering this storm, however long that may last. Diversification obviously is key. You want to diversify in some assets that have some guarantees. Your personal bank does that. Reducing taxes is another good way of making sure you have more money in your pocket. Well, your personal bank does that too. You can create a tax-free bucket of money and grow that tax-free, access it tax-free, and pass it to your heirs tax-free on an income tax-free basis if done properly. And like I said, we, of course, do that. But most importantly, you can create a positive cash flow on money that you invest. In other words, you can take money you're going to invest elsewhere, put it into the policy during the dividends, 5.75%, 6% dividends currently. We fully expect those to be on an increasing track as interest rates increase. Historically, 7-8% is a norm. These are companies that never missed a dividend since before the Civil War. You're earning these dividends to maximize the cash growth on a guaranteed, steady, consistent basis, and then you access it through a bank line of credit at a lower rate, and you keep the difference, a positive cash flow or a positive arbitrage. And the difference is about 2-3% on average for most clients I work with. That gives you an extra 2 or 3% return on your money. And if your return, as I said in the first segment, is 10%, you're now making 12, 13%. Folks, it's that simple. And with inflation, where it's at, you need, again, to have your money go further. This is also going to come into play if you're in a situation where you will be borrowing money, you think, in the future, because as interest rates climb, as the Federal Reserve has stated, they're going to increase them 3 or 4 times in 2022 is the plan. The cost of borrowing will increase. Well, your personal bank can offset or reduce that cost of borrowing, again, with the positive cash flow, the positive arbitrage. It can reduce your cost of borrowing by 2 or 3%. Well, if you have a 5% car loan, for example, you could reduce that to 2 or 3% car loan. Which would you rather do? Would you rather borrow your money 5% or net of 2 or 3%? These are the things that your personal bank can do. So whether it's you're using the money to invest, you can increase your rate of return. If you're using the money to, if you're borrowing money, you can reduce your cost of borrowing. It can also help you reduce debt, things like that. There's a lot of purposes, a lot of uses, a lot of ways that your personal bank can improve, increase, enhance your financial position. Contact me at toll-free 866-268-4422 or yourpersonalbank.com for more information on how this can work for you. I'm going to encourage you to stay tuned in the next segment, and I'm going to share one more thing that we should be on the lookout for, an idea that's being floated by some in our government, and we want to be cognizant of this, because if they decide to go down this path, we could see substantial upheaval in our economy. And so we want to be aware of that, be prepared for that, not be surprised by it, okay? You got to plan accordingly. I always say plan for the worst, hope for the best, and plan for the worst, right? That's the key to successful planning and navigating the storm. So stay tuned in the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And as I was stating in the last segment, what are some other things we need to be cognizant of or look for? What is our government considering throwing out at us next? Well, here's one of them, a trial balloon, I think it is. But something they're considering, and I think folks need to be aware of, so that we can plan accordingly and not be surprised. And that is, well, they're starting to talk about price controls. Now, here's the thing. The reason, obviously, is, again, the high inflation. When the costs of goods and services are increasing, the typical average person is not happy about it. Not happy because they're paying more for bread and food and energy and just about everything else, the basics of what we need. And when inflation, the cost of things increase, that the populace is not so happy, and of course tend to blame the government, whoever's in charge, the leadership, right? Now, of course, the politicians, or those that are in charge, want to get reelected. So that's a bad recipe, a bad combination. So one of the things that they're talking about doing is they're saying, look, should the government control the price of food and gas, for example? Now, the problem is, if you don't know, I'm going to give you a short, quick education on this. The government setting price controls, economists overwhelmingly agree, is a really, really bad idea. It might work for a short period of time, which, of course, the politicians want quick solutions, right? Because they got to get reelected in the next cycle. That's why that's the problem comes about. And that's why I think this is a valid thing to be concerned about this year, because we have midterm elections coming up towards the end of this year. Are they going to try to do something like this to try to get a temporary fix and create another bigger problem? We'll see. But whenever price controls are targeted and imposed on a range of goods, it basically, what it does is capping prices encourages companies to produce less of a product because there's less profit, right? And therefore, it makes it more, making it more attractive to customers. But supply goes down and demand goes up. The old basic supply and demand. If you artificially suppress or reduce the price of goods and there's a demand for it, more people want it, the demand goes up, the price is locked, the companies are just going to make less of it. Okay? And then, in essence, what happens? Now you get shortages. So you start having food shortages, for example, or gas shortages. We saw that in the 1970s with gas lines and things like that, evens and odds. Those of you that are not old enough to remember, there was a period of time in this country where you could only fill your gas tank up if on certain days, and it was based on your license plate number. If your license plate number ended with an even or odd number, was that day you would determine which day you could fill up your tank. And if you were off day, tough. You were out of luck. You couldn't do it. Those are the kind of things we have experienced even in our country that could come about again, especially if the government starts flirting with the idea of price controls as a short-term fix so they make everybody quote-unquote happy so they can get reelected, right? So here's the thing. Like they talk about, price controls do have a role, but they buy time and to deal with bottlenecks sometimes when a pandemic prevails or panic, okay? And but they do that because, again, like I said, the cost of waiting for inflation to go away is high. I've said this before, it takes a while for inflation to go away. This whole idea of when the Federal Reserve last year was saying it was transitory, I knew that was a bunch of bull hockey, and I said it. And most experts said the same thing. The Federal Reserve didn't want to admit it. They finally did for political reasons, in my opinion. But what happens is, when, like an example, when Nixon tried to cap prices, temporarily it brought inflation down for a period for about 90 days, and then it doubled. It went down to like 5.8, but then shortly after that doubled to 11%. The thing is, it's a short-term fix with a longer-term problem. We had supply chain issues before. Price controls will create another supply chain issue, which will create more problems, more demand. Just let the market do its thing. But politicians have a hard time being patient because people are unhappy. There's demands for the leaders to do something, which is frankly foolish, because the more they do, the more they monkey with the system, so to speak, the more often they mess it up further. And again, it's appealing because it can create a short-term result, which is all that many politicians care about, getting reelected, right? Therefore, creating a longer-term problem. Diversification, that would be a key solution. Increasing the rate of return on your money, make your money going farther, those kinds of things. Your personal bank can accomplish both of those things. Contact me at yourpersonalbank.com or toll free 866-268-4422 for more information. Stay tuned in the last segment. I'm going to cover some other ideas and some things I think you'll find very valuable going forward. So, again, don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We're going to wrap this up today with some ideas that really I've been sharing quite often recently with some new clients. And it comes down to this. Like I'm going to use an example. One of our new clients I talked to today. He sold a property, he got some money in, and wants to also build a nest egg for the future over the next decade, but also has a chunk of money to work with. So one of the things, and he understands the value of the positive cash flow, positive arbitrage, concerned about the markets and where they're going right now. I think rightly so. So what we recommended, what he's doing is basically setting up two policies. One where he puts in what's called a front load, where he dumps a chunk of money in to maximize, again, the cash, maximize the dividends. He's going to have about 85% of his money liquid available day one, earning a 5.75%, 6% dividend right now, likely to be higher in the relatively near future as interest rates increase. Historically average 7-8%, by the way. And going to be able to access those funds right now to 3.25%. So right now he's getting about 2.75 positive arbitrage on that money. And he mentioned, and then he's also doing a second one where he's going to fund a chunk of money each year for the next decade, again, to build a nest egg. So he's doing One where it's a chunk up front, another where he's doing funding so much per year. We do that quite often with people, with clients. So there's more than one way to accomplish this, is what I'm trying to say. So it doesn't matter if you want to fund monthly, quarterly, annually, or all at once for that matter. You can go at it any way you want. There's tons of flexibility. But he also mentioned, which I thought was quite interesting, he said, he had been doing some real estate renovations and things like that, and had put some money on the credit card to accomplish that. And so he wanted to dump that high credit card interest. So I said, absolutely. He's going to take a chunk of that money from the bank line and pay off the high interest credit card. Well, one, that eliminates that bill, right? That expense and all the interest that would have been associated with it. So that's gone. Plus, he's going to still earn 2.75% interest on that money. And, he told me his credit card interest was, close to 20%. Most people, it's at least 15, 18% plus, right? So if he's not paying 20%, for example, and earning another 2.5-3% on top of that, well, the swing is like 23% difference on the money, right? Folks, that's significant. And then he pointed out he owed about $10,000 on a car, and the interest rate on the car loan was still a little higher than he liked. So he's going to take that money and pay it off and wipe that bill out too. Well, what is that going to do? Again, same thing. Wipe out the debt, wipe out all that interest, and still earn interest on that money. Here's the thing. He sold the property. He has the funds. He could wipe out those debts and pay it off and be done, right? And he would accomplish getting rid of the bill and getting rid of the interest. But here's the problem. Here's where most people miss truly maximizing the capability of the growth in their money. If he took all that money and paid off their credit cards and the car loan, for example, would he ever earn any interest on that money ever again? And the answer is no. Of course not. He paid off the bill. The money's gone, right? Forever. Well, here, he's still going to be able to earn some interest on that money every year for the rest of his life. Now, he happens to be, not young, but not old either, okay? So he's got several decades left in his lifetime to live, most likely. So the amount of funds we're talking about here, the amount of interest he's going to earn, will be in the tens of thousands of dollars of interest, folks. Well, here's the thing. As I stated to him, do you want that interest? Do you want that extra money over the next several years or not? Look, you're going to pay these bills. You got the funds to pay the bills. You're going to pay the bills off. That makes sense. Do you want to earn interest on them also? Do you want to cash flow off of that money or not? See the difference? You see how your money's growing, working double time, so to speak, for you? You're earning more. Your money's going farther than it was before. Because, again, if you pay off the bill, it's gone forever, right? This way, by putting in the policy to earn dividends, access to the bank line, keeping the difference, 2.5-3% interest, using that money to pay off the bill, you still earning interest on those dollars, still gaining a positive benefit from those dollars paying off the bill. Is his money going further? The answer is yes. Will he have more money in his pocket over time? The answer is absolutely. Now, you can apply that same principle with investments or debts or anything else for that matter, or purchasing an item, okay? I had another client who this week, similar situation, had a chunk of money in an investment that she's not particularly happy with, particularly right now. The markets have been taking some turns for the worst, and wants to put them into, a lot of people are moving to cash and stuff to reduce risk and stuff. But having the money sitting in the bank, which is in essence what she was doing, or in a brokerage account in cash, meant she's earning less than 1% interest on those funds, as most people are. And for how long that's going to last, we don't know, because as I stated in the previous segments, if you missed it, folks, inflation is still increasing, okay? It hasn't abated yet. The producer price index and consumer price indexes are both increasing each month over the last several months in a row. We don't know where the top is yet, and it hasn't started decreasing yet. So the bottom line is, even if this is the peak, we have months and months, if not a year or two, probably, for it to abate, so to speak. It's going to take time for this to abate. And we're not sure if we don't know if we're at the top yet, okay? So it might be a year or two or longer before she wants to reallocate those funds. And then there's a lot of people right now are in that situation. They're kind of getting out of the way, right? Well, why just sit in cash earning next to nothing? Why not earn 5.75 dividends or 6% dividends right now on the money, tax-free with guarantees? And then when you're ready, when you see an opportunity, look, I'm not saying there's not going to be any opportunities going forward. Of course there will be. You can then pull the trigger and take advantage of those opportunities and still get a positive cash flow on it. You see what I'm trying to say? See, this is the thing that surprises people often. Personally, I invest in the stock market. Personally, I've often invested in real estate. I invest in businesses. I'm on a bank board right now actively looking at starting a bank, which requires some investment in a startup business, a startup bank. I've done this before. I am an investor. And if I look at it, why on earth, knowing what I know about positive arbitrage, why on earth would I ever take money and just take that money and invest it in a stock or a piece of real estate or a business without first putting it into a policy to earn dividends, access through the bank line of credit, and get some 2 or 3% interest, and then take those dollars and invest those dollars? See, it's a common refrain I share with people is you have a choice. You can take money that you have to invest, and you can invest that money and get whatever rate of return you're going to get. All right? Or you can take that money, add just one step. That's it. One step, and you can increase the amount of your rate of return significantly and increase the amount of money in your pocket significantly. Get your money to work for you further significantly by putting in the policy to earn dividends, access to the bank line, keeping the difference, and investing in that asset. See, I refuse to take money and just invest directly into an asset. And many of the people who operate that way, banks and wealthy individuals and corporations and all that, operate in the same manner. Many institutional investors, because here's what we know. Here's what they know. One, with a positive arbitrage, with a positive cash flow, that increases the rate of return on your investment. It also increases the likelihood of success on your investment. Because if you are getting a 2 or 3% return, no matter what that investment does, the investment could go flat, do nothing. It could sit there for a while, and you're still moving forward. You're still positive, net positive. Look, could we see that in the stock market going forward with a number of investments where you invest in something that looks like it's going to do well and it just kind of just sits there because of inflation or various other factors? How about real estate investments? Could we see a flattening, a lack of it increasing in value for a period of time? Absolutely. Starting in a business, could you see that? The answer is absolutely in all those scenarios. In fact, all those scenarios, you could even see reductions in value for a period of time. Hopefully not forever, but you see my point. It increases your likelihood of success. It increases your overall rate of return. Even if the underlying investment, the asset you're investing in, doesn't do what you think it's going to do, even if that asset does nothing, you start to understand what I'm saying. So when people question why I do what I do, which doesn't happen that often anymore, or they're saying, well, I can do better somewhere else. No, you can't. Because whatever you do somewhere else, you're going to add on an extra 2 or 3% to that rate of return. So you will always mathematically have more money, right? That's where they miss if they do miss the boat, that's where they miss it. So, I'm just going to encourage you. I'm not trying to, I'm not going to hard sell anybody. I'm just going to educate you and help you understand how you can benefit from this, how you can increase your rate of return, how you can increase the success, like the likelihood of success on your investments, particularly more important in an economic situation where things are different than they were before, certainly, and less, how should I say, less likely of success, more risk, right? So contact me at toll-free 866-268-4422 or yourpersonalbank.com. You know, when things are just going up and up and up, like the stock market has done for the last decade or so, and real estate basically has done for the last decade or so in many markets, you can get sloppy. You can kind of get lazy. You can almost like throw a dart board and pick a stock or pick a piece of property or whatever, or cryptocurrency or whatever it may be, and most likely win. You can kind of get sloppy. You can kind of even get lazy and still succeed. But it creates sloppy habits, sloppy investors, sloppy processes. When things aren't so certain, when you have higher inflation, you have uncertainty in the markets, you have changing economic situations like we're experiencing right now, you have to get more disciplined. You have to be more efficient. You have to get smarter, more financially savvy. You have to make your money work for you further and do more for you just to keep up. Not talking about doing better, just to keep up. You have to increase the likelihood of success in your favor. You have to stack the deck in your favor as much as possible. And creating a positive arbitrage on your money in addition to investing it, well, it's one of the best ways to do it. And logically, there's no logical reason for not doing it, frankly. It just increases the likelihood of success, and it increases the rate of return on your money, on your investments. It's just that simple. There's other benefits involved, again, more liquidity, reducing your taxes, other things like that. There's long-term care benefits built in and no additional cost. Okay, those kinds of things which are certainly a benefit for people, no question. But increasing the likelihood of success and increasing the rate of return in a high inflation economy are key. Contact me at toll-free 866-268-4422 or yourpersonalbank.com for more information. And as I often like to say, with everything that's been going on in this country, I'm proud to say I'm proud of my country. I'm excited about what's happened recently. I'm proud of our country protecting our freedoms. And as long as it's still on our money, I just want to say, in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.